my career working for Peter Marcus, who some of you might know. He made the joke that a lot of analysts have heard that one of the qualities of a good analyst is a certain level of amnesia regarding former forecasts. And so you have a tendency to forget when maybe you were early or late or whatever the case may be to the market. But I'm happy to start this year's presentation by looking back to last year and being able to say with confidence to a certain degree that we were relatively close to where we were aiming in 2024. Our forecast last year called for average prices of hot-rolled oil in the US to be about $770 per ton. This year, at the rate things are going through this point of October, we're approaching 761 to be precise. So we're within a fairly comfortable range, and you know, as an analyst, that always gives you this little bit of oomph going into the next big forecast. So I'm going to give a brief rundown of what I'm going to try to accomplish here with the USA forecast for now. I'm going to start with just a look at the paradigm that we've been in this post-COVID environment that's really been defined by significant volatility both in pricing and steelmaker profitability over the course of time. Then we're going to go through the major drivers of our demand forecast and look at what's going to happen with steel demand between now and 2027. That's going to tailspin us into what the supply-demand balance here in the United States is going to look at like. There's obviously going to be a lot of questions as 6 million tons of additional sheet capacity comes online between Big River and Nucor in the next 3 years. It's going to impact the market. And that's going to lead us to a conversation about metallics and the impact on scrap prices, which ultimately are going to be a key driver or floor on HRC prices in the next couple of years going forward. So looking at the last now almost 3.5 years, it's been a bumpy road. We've been on a roller coaster. There's been these continuous stocking and restocking cycles in the U.S. market where inventories get super low, they get tight, imports fall to a relatively unsustainable level and around the 7.5 to 8 million ton annualized rate, and all of a sudden we get supply constrained and prices spike. Sitting here last year, where the prediction might not have held up, we were sitting at a price environment of about $675 a ton, and I think very few in the industry would have anticipated that in the next 3 months prices would go soaring to about $1,100 per ton, where it stayed for most of December and January of last year. But like I said, we've kind of been going in this whirlwind of all the way up, all the way down, but WSD senses that we're kind of approaching the end of the momentum in that cycle. The same thing, as I said, has been the case with metal margins, where you've gone to periods of record profitability for the mills. Metal margin, for those of you that don't use that terminology, is really just the spread of hot-rolled coil versus the shredded scrap price. It's a decent measure of price versus cost. So you've gotten these spikes over and over again, and then quickly go back down to reality. We see things flattening out quite a bit over the next 3 years versus the previous. Part of it is economic stability. Last year when we were standing here, the conversation on everybody's mind was, when is the recession going to happen? It wasn't even if. It was, the economy has been running too hot for too long. Inflation has, been soaring over the last number of years. The economy is incapable of keeping this, this rate. And what's happened is we've fairly continuously had good economic returns year over year. But an interesting element in all of this is even as interest rates are beginning to be cut, even as inflation is going back to its benchmark level or its comfortable level in the low 2% region, there's a lot of varying feeling of how the economy is, how consumers should be spending money, how businesses should be investing their money, whether it's in capital goods, whatever the case may be. Some of this is simply based on your political affiliation, the news you consume, the information that you're receiving, and what's particularly interesting about this graph and why it's very relevant as we're going into a presidential election. You look at what happens every time administration changes office, marked by the red dotted line or blue dotted line. Right before Trump took office, Republicans thought the economy is doing bad. Trump takes office, Republicans' mood over the economy goes up and stays up for the majority of the next 4 years. Biden gets elected, that line goes straight down, and the Democratic line does the same thing. But mood is important to the overall investment cycle that that we see in the economy, and again, the items that drive steel consumption. And Gallup, as early as this morning, and this is perhaps as important of a political factor as any, 52% of Americans are sitting in a place where they don't feel like they're in as good of a place as they were 4 years ago. Only 36% of respondents said they were in as good or better of a place. And so, you kind of have this wet blanket, despite economic growth during this period of time, economic growth and wage growth and low unemployment. All those factors don't matter if the general mood around the economy is not particularly good. And we're seeing it in the steel world. Across all the major steel-consuming industries, really, excluding ones that are very impacted by government spending. So defense and rail infrastructure is doing great. Construction is doing great with all the money flowing in. You're seeing a relative slowdown both in the near term and continuous momentum around many of the major steel-consuming industries. When you take it as groups of long lead time capital goods or short lead time capital goods or consumer goods across the board, steel demand is not particularly great, and in 2024 we see it down in the 1.5% below 2023 levels. When you look at automotive, which is maybe the most consumer-driven group, it's been a very flat year. Total sales last year were 15.7 million units. This year, Cox Automotive has the forecast at 15.7 million units. But there's some reason for optimism here, because we're still very much sitting at a point in the automotive world where sales haven't quite recovered to their pre-COVID levels. We're still sitting about 1.5 million auto units below what was fairly typical in 2017, 2018, 2019. This particular industry has been maybe the most visibly hit of a lot of consumer durable items. As far as inflation, we've seen the auto average new car sales going from an average sale price of $34,000 to $44,000. High interest rates are certainly not encouraging buyers to run into auto dealerships and make major capital decisions. And just general uncertainty again is plaguing the market to a certain effect. So we see over the next 3 years potential upside in automotive. construction has, in a lot of ways, been the savior of steel consumption over the course of 2024, and we really don't see demand in this segment going down significantly in the next 3 years. Last year we flashed up the slide. It's really quite popular in steel conferences like this. You've got the Infrastructure Act, you've got the CHIPS Act, you've got the Inflation Reduction Act, and there is a lot of government money going into encouraging development, whether it's in the form of bridges and tunnels to hospitals and so on, and other forms of energy. So basically, we see this as a driver of growth over the next year or so. As we deeper dive into it, construction starts, which might be the best indicator that we can be looking at from the perspective of driving future growth. Through the first 8 months of 2024, total construction starts are up about 4% versus the same period in 2023, with non-residential starts up 3%, residential building starts up 8%, and non-building construction down 8%. After a 2-year surge in spending following the passage of the CHIPS Act, new starts in the manufacturing sector have not necessarily maintained their level, but what we've continuously seen is month after month, there's a new $500 million data center being built, either in Texas, Indiana, Ohio, wherever California, you name it, and there's data centers being built at a rapid rate. It's a reaction to the insurgence of AI into the economy, the need for increased computing power. Data centers are popping up one after another. Residential starts have actually been probably the weakest for most of 2024, and this particular segment, which has limited influence from the government currently, also has maybe the most potential for its own natural growth. There is